Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always, Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. OpenAI buys Software Applications Incorporated, a company that built an artificial intelligence interface for Apple computers. Post the deal, all 12 members from the company will join OpenAI. This comes weeks after OpenAI acquired StatSig, a product development startup.
Uniphore, an AI company, has secured $260 million in a Series F funding round at a valuation of $2.5 billion. This investment will help support its innovation strategy, particularly focus on its AI and data platform, business AI cloud, and further expansion of ecosystem of enterprise clients.
Zomato founder and CEO Deepinder Goyal launches a $25 million self-financed fund under his initiative Continued Research. It aims to support scientists studying the fundamental mechanisms of human aging. He describes the endeavor as a multi-decadal journey.
Anthropic and Google officially announced their cloud partnership, a deal that gives the artificial intelligence company access to up to 1 million of Google's custom-designed tensor processing units. The deal, worth tens of billions of dollars, is expected to bring a gigawatt of AI compute capacity online by 2026.
IPO-bound fintech startup BharatPe has roped in former Paytm Senior Vice President Ajit Kumar as its new Chief Technology Officer. This comes months after previous Chief Technology Officer put down his papers. Kumar is set to spearhead the company's tech strategy and innovation.
Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. From a Chennai startup pioneering voice automation to a Palo Alto-based business AI powerhouse, Uniphore's journey captures the global rise of enterprise AI. Uniphore has just raised $260 million in a Series F round, backed by tech giants NVIDIA, AMD, Snowflake, and Databricks, taking its valuation to $2.5 billion. As AI moves from pilots to production, Uniphore says it's ready to power what NVIDIA calls the Agentic enterprise. To take us through what this fundraise means and what's next for Uniphore, joining me now is Umesh Sachdev, the co-founder and CEO of Uniphore. Umesh, welcome back to Startup Street. $260 million Series F round, one of the largest this year in the AI enterprise space. Walk us through what this raise means for Uniphore, especially given the mix of investors like NVIDIA, AMD, Snowflake, and Databricks, and how strategic is this beyond just capital?
Shruti, always a pleasure to be back on the show with you. Obviously, this is a very exciting milestone for Uniphore, but I would say a very exciting milestone for, in general, the adoption of business AI for the whole globe. What we are seeing with this funding round is not just a validation of Uniphore's growth and how prominent we are becoming with the Fortune 500, Fortune 1000 companies, but also a big validation that the whole ecosystem needs to come together to drive AI adoption. And that's why we are seeing participation in our Series F from NVIDIA, AMD, Snowflakes, and Databricks.
Sure.
And I think it's a very exciting moment.
All right. This round, like I mentioned before, values Uniphore at $2.5 billion. Umesh, can you unpack what this integration could look like for clients? How is Uniphore going to truly enable agentic enterprises, as NVIDIA described, further ensuring Uniphore's growth is built on real enterprise adoption, not just AI buzz?
Well, if you think about what is driving the adoption of agentic AI in some of the biggest businesses, Uniphore's customers, over 2,000, happen to be some of the biggest banks, telecom companies, insurers. The CIOs in these companies, as they look to adopt agentic AI, first and foremost, they want optionality. It is not one size fits all. For very high reasoning use cases, they want a big LLM, a big GPU. For cases, let's say in finance or HR, where the latency can be pretty high, you don't need real-time responses, a small model and a smaller GPU can work. This is what Uniphore delivers. We are at the tip of the spear. We bring together the GPU infrastructure, the data infrastructure, and the agentic infrastructure, and we provide all the options to these enterprises. That architecture, Shruti, is what's driving the growth.
All right, Umesh, when we last spoke in September, you had announced the acquisitions of OrbiAI and Autonomate, bringing in top talent from DeepMind and Google to supercharge the business AI cloud. Tell us, how have those integrations strengthened Uniphore's capabilities?
Well, it's hard to believe those acquisitions are less than 2 months old for us, and we're still heads down trying to integrate them. But already our top 50 clients are using in three different ways the capabilities from Orbi, Uniphore, and Automate put together, even before we managed to fully seamlessly integrate the technologies. With Orbi, what we gained was an agentic process discovery, where we can go into a company and without the company having a documentation for themselves, we are able to discover their current manual work and then agentify it for them without them having to do anything. So I think we are delivering an end-to-end automation in a sovereign and open manner. And this will only accelerate next year as we fully integrate those acquisitions.
Sure. Like you mentioned, you now count over 2,000 clients. Where are you seeing the fastest adoption of Uniphore's platform? Is it customer experience, internal operations, or decision automation? And where does this multimodal AI take your business next? Emotion recognition, video intelligence, or autonomous decisioning?
Well, if I think about my customer base, there are 4 industries which are leading the charge as far as our customers are concerned. Financial services, insurance, telecom, and retail are the 4, highest adopters of agentic AI in our customer base. Use cases around internal automation, reasoning, these are taking fold. 2-3 examples: claims automation in insurance, billing automation in telecom. Or for a big 4 firm, a consulting firm in the world, every industrial domain that they work on, they're now agentifying and delivering their consulting services through an agentic architecture.
Sure.
This, Shruti, is a full rewrite of the tech stack in the enterprise.
Okay. Umesh, as you scale globally, where does India fit into Uniphore's roadmap in terms of talent, innovation, or enterprise market opportunity?
Well, as you know, India is where the roots of Uniphore were. We're an IIT Madras incubated company before we moved the headquarters to Palo Alto. India is a huge talent market for us. We have our AI innovation hub in Chennai. We have our engineering centers in Bangalore, and those continue to scale for us. India continues to also be an opportunity for acquisitions. Automate, as we announced a month and a half ago, was a Chennai-based company. As far as the enterprise markets are concerned, vast majority of our revenue are between the US and Europe. And Asia, starting with Middle East, India, Australia, are beginning to show early promise of agentic adoption.
Okay. One final question before I let you go, Umesh. You've now got capital, strategic partners, and product market fit. What is the next big milestone? Are we looking at an IPO on the horizon?
Well, really what we're focused on for the next 12 to 15 months is how do we grow our customer base from 2,000 to 4,000 to 8,000? We really want to keep our growth rates high. We see a huge opportunity, and our customers are telling us that they're beginning to see big ROI with us. As that happens, Shruti, as you rightly said, we are now a Series F company.
Yes.
The total capital we've raised is over 850 million. So at some point in the future, becoming a standalone publicly traded company would be what we'd like to do. But right now, we're just really focused on that customer adoption.
All right. So you've not given me a timeline. But on that note, it's time for me to wrap up our conversation. Umesh, as always, it's a pleasure speaking with you. Thank you so much for joining us on Startup Street.
Thank you for having me.
Well, and what else is brewing today? Chara Technologies, a homegrown deep tech startup developing rare earth-free motors designed, engineered and built entirely in India, recently raised 52 crores in a Series A round that was led by Artha Ventures. Founded in 2019, the company is betting that magnet-free motor systems can make EVs both more affordable and geopolitically resilient. With the fresh funding and plans to scale production 5-fold, it is now testing whether India can not only assemble EVs, but innovate the powertrains that drive them. For more on this, joining me now is Bhakta Keshavachar, the founder and CEO of Chara Technology. Bhakta, thank you so much for joining us here on Startup Street, and congratulations on your fundraising. Before we get to that, you were founded in 2019 when the EV industry was still in the nascent stage. What gap did you see back then in the supply chain that made you believe, rare earth-free motors can be a viable alternative?
Thank you for having me here on the show. Much appreciated. When we started Chara about 5 years ago, there were three main goals. As we are transitioning from a hydrocarbon economy to an electron economy, we need to build efficient and sustainable motors. The only way to build an efficient motor today is to use rare earth magnets, usually called PMSM motors. And rare earths have this few problems. They're expensive. They're difficult to mine and extract, both economically and environmentally. And the last but not the least, our friendly neighbor, China, has 90% control over the supply chain. And that's why we wanted to build a sustainable, made in India, rare earth free motor, which are completely free of critical materials on foreign sources, and potentially build a cheaper motor to enable our transition to an electric future.
And, Bhakta, now that you've got this 52 crores, how are you going to deploy that to scale this, powertrain platform you're building?
So before going there, where we are today is we have developed the technology, we have the products, we have the customer traction, we have about 100 plus customers. We are shipping the initial lot of motors to be deployed in a variety of applications. The infusion of capital, we are using it for the following three purposes. One, to scale up our deployment, both in India and outside India, develop newer products, our next-gen products, which are higher speed, larger capacity, and lighter motors. And the last one is to increase all our operational capacity to support this deployment and newer products.
Okay, you have these plans to increase production fivefold to 100,000 units annually. Just take us through what the biggest challenges in scaling deep tech manufacturing in India really are today and how are you addressing them?
So we have found like three problems probably. One is, number one is talent. It is difficult to find core engineering talent in India. We have to train them or we have to get graduates from foreign universities. Or the top tier universities. That is problem number one, finding talent. Problem number two is the capital. We need patient capital for a deep tech company to go from R&D to manufacturing. And the last one is the market acceptance of a new technology. We find a lot of reluctance to use our reluctance motors by a lot of our customers because it's so new. And fortunately, with the tailwinds of the geopolitics, there is a lot more affinity to use our motors in their products.
Well, Bhakta, you've outlined the challenges, talent, patient capital, and the acceptance of new technology. What did you really do to overcome these to get where you are?
Patient capital, solving it through patience, passion, perseverance. That is the only way to say it. We took 5 years to develop this product, giant in the world, and as you guys have mentioning, fully certified by the certifying agencies in India. But at this point, I would like to say that there is now capital available for seed round and pre-series A round and potentially series A round for deep tech companies in India. That thing has changed positively in the last few years. The talent, we have two-pronged approach. One is that get engineers from the Indian universities, various tiers, tier 2, tier 1, tier 2, tier 3, and train them. And try to attract talent from foreign universities. We now have graduates from, like large universities like Carnegie Mellon, Vienna University. I think those are the two approaches we have taken to solve our talent problem. In terms of making our customers adopt newer technologies, again, two approaches. One, we have tried to work with smaller customers who are more hungry, who are more ready to adopt new technologies. This one is the tailwinds we got from geopolitics is making us a favorable.
Sure. Bhakta, quickly before we let you go, a six-fold revenue jump by FY26 is what you're targeting. What's going to drive that growth and how will you balance this aggressive expansion with the long product validation cycles, which you also spoke of, typical of automotive tech?
Yes. So we have already started on the journey of the validation. We have secured customers last year, and they're all ramping up now. We now have the manufacturing capacity installed in our factory in Pune, north side of Bangalore, which can do about 25,000 motors a month. And fully validated, that gives customers the comfort that this is a product that works. And there is a bunch of customer validations both inside and outside India. And I already told this 2 times. The tailwind of the geopolitics will help us accelerate much faster.
And quickly, you're also eyeing North America and Europe next. What will be the go-to market strategy for these markets, which are believed to be highly competitive regions?
The go-to market strategy, before we go to Europe and US, we first want to deploy about 10,000 motors in India across applications. So we have the proof that these motors work in the real field. And then in terms of go-to-market strategy, we will initially target what we call as the off-highway applications, like agricultural equipment, in-campus vehicles, where the competition is a little bit less fierce and the sales cycles are much faster. And then we move on to the usual traction motor applications.
All right, Bhakta, we'll have to leave it at that. But thank you so much for your time here today on Startup Street, and we wish you the best with your venture. Thank you.
Thank you for having me here. Thanks.
On that note, it is time for us to head into a short break. But coming up on the other side, Artha India Ventures has announced the launch of its 500 crore rupee Artha Venture Fund 2 with a strong 250 crore rupee first close already secured. Backed largely by Indian investors, we speak with Anirudh Damani, the managing partner of Artha Venture Fund. On the other side, stay tuned. Welcome back. You're still with us on Startup Street. Artha India Ventures has announced the launch of its 500 crore rupee Artha Venture Fund 2 with a strong 250 crore rupee first close already secured. Backed largely by Indian investors, this new fund builds on the success of Artha Venture Fund 1, which was ranked number 1 in India and number 2 globally for its stellar returns and category-defining bets like Agnikul, Cosmos, Lendon Club and Everest Fleet. With India's early-stage ecosystem seeing a funding reset, Artha is doubling down on high-conviction seed-stage investments, focusing on premium consumption, fintech infrastructure, applied AI and deep tech. The goal to back resilient founders, building capital-efficient, scalable businesses that can power the next decade of India's startup growth story. Joining me now to discuss this further is Anirudh Damani, the managing partner at Artha Venture Fund. Anirudh, it's great to have you on the show. Thank you so much for joining us today. You know, Artha India Ventures has now crossed 1,500 crore rupees in AUM, and you've announced AVF2 at 500 crore rupees. What does this milestone mean for the firm and for India's early stage investing ecosystem?
First of all, thank you so much for having me on the show. And I think it's quite surreal to be sitting here and talking about Artha Venture Fund 2. Because when we started Artha Venture Fund 1, we were India's first and only early stage micro VC. But I think the model of being a small size fund, having high ownership stakes and being able to double down on your winners, the family offices and Indian investors have really taken to it, and which is showcases in the fact that we've had such a strong first close, and we're looking at probably closing out the fund by the end of this financial year, and with a green shoe probably by June. So that all this tells us is that we're doing something right. The returns are there for everyone to see. We've backed category-winning companies in Fund 1, and we've also continued to back those winning companies even through Artha Select Fund in those B and C rounds. And the results are for everyone to see.
Absolutely. So hoping to close this round out by the end of this year and the green shoe option by June of next year. You've already raised this 250 crore rupees in the first close, right? So what kind of investor confidence or momentum are you seeing, especially from, domestic LPs, which make up 90% of your base?
I think the confidence has been quite stellar, to be fair. We were hoping that this would have a lot more participation globally since we were setting up our GIFT City structure as well. But before we could do that, the check sizes we received from the Indian family offices have truly been astounding. Some of the family offices that were in Fund 1 have come back with check sizes 5 to 10 times higher than what they put in Fund 1. We've had new family offices. Some of them have put in check sizes that are actually larger than our own check size in the fund, which was really heartening and really gave a strong boost of confidence to the entire Artha team that has been working diligently on building category-winning companies in India.
Absolutely. And, through this fund too, right, how many startups are you looking to invest in? What are going to be the check sizes? And have you already deployed any of these funds in companies?
Absolutely. So I think this is a great time to be investing. We talked last time as well about the graduation rates, how they have fallen. The graduation rate for us is, in a defined period of time, how many startups, raise the next round of capital. And I think usually in the seed to Series A conversion over 3 years is roughly 13 to 14%. Right now, that conversion rate is as low as 5 and 6%. So it tells you that obviously the ecosystem has had a major hit after the boom years of 22, 23. Therefore, we've deployed even before the first close. We started warehousing companies. We've finished 5 investments so far. 3 have already been announced. We'll announce another 2 shortly. We have another 6 companies in the pipeline. We were looking to close them by the end of December. So we're hoping to finish 36 seed investments from this fund, 36 seed investments, average check size of between 4 to 5 crores. And then we'll double down in those same companies in pre-Series A with, between 8 to 10 crores, and Series A will be between 16 to 20 crores, incrementally giving more and more capital to the founders so that they don't have to worry about capital as long as they're building a fantastic company.
So 36 startups on the radar there, and you're going to announce another 6 more soon. You're focusing on premium consumption, fintech infrastructure, applied AI, and deep tech, right? So what's driving your conviction in these 4 themes, and where do you sort of see the biggest breakout potential?
I think a lot of this also drives from the way we ended Artha Venture Fund 1, and I think Bhakta was talking earlier about how the funding scenario for deep tech in India has changed. We're not the deep tech guys. We're not the guys that completely understand the technology, but we're the people that understand the dhanda behind the technology. And that's what we've really discovered our niche or our knack for with Agnikul, obviously in Fund 1. We've discovered in Fund 2, we did Take Me to Space, which is already getting ready to launch its satellites for creating data centers in space. And we're looking at space tech and semiconductors being a very important theme, both as a country, both as a China plus one strategy geopolitically. But we also feel that we have the requisite talent and the requisite infrastructure to create world-beating companies when it comes to space tech and semiconductors out of India. DLI schemes, IDEX, the fund created by the government for space tech, all of these are boosters, as well as in space. All of these are boosters, and they're creating a fantastic platform to see deep tech companies that will get to commercialization faster in India for the globe. And then on top of that, we think fintech infrastructure, just the fact that Indian consumption story is really just getting started. We need more credit cards we need more credit cards, we need more consumer credit loans. And for that to happen, the banking infrastructure has to improve. Most cooperative banks or most small finance banks don't issue credit cards. They don't probably have the technology for it. And those are the places where we see fantastic opportunities for fintech infrastructure companies to come and really work with these banks and NBFCs to flow more credit through the economy. And lastly, I think premium consumption, to us, Indian consumption story is a 20-year play. But in that, we see that top 6%, the people that, are earning between $15,000 to $20,000 a year, that ecosystem itself has a very different consumption pattern than the rest of the economy. And they typically have much higher margins over there. So we want to focus on both consumer products or consumer services, just catering to that top 6% of the economy. And I think there's a pot of gold for founders to make, especially in that top 6%, the affluent Indian economy, as you would call it.
Absolutely. So a couple of big bets that you pointed out, especially the sectors. You also mentioned earlier there was a drop in seed stage activity, right? Fewer than 100 deals a month this year. In this sort of challenging environment, what made you feel that this was the right time to launch the new fund?
I think this is so when you've invested for 12 or 13 years, and obviously the family history of around 45 years in the capital markets, you realize the best investments are made in bear markets, right? Because valuations temper down and the real founders come out, in my opinion. Like the tourist founders are gone because it's difficult to raise capital. The due diligence timelines are much longer. A lot more questions are being asked. People are asking founders to tighten their belts. In this kind of a environment, the best founders actually are the ones that have pure passion driving them, and they really have a need to solve it. It's not all the bells and whistles that are driving them to become founders. I think this is the sort of timing that we've made a lot of money in, even in the last, maybe 2016, 17 again, when a similar situation arose. Funding velocity went down, the graduation rate went down. We made fantastic investments in those years, right? We found Karda technology in those years, and it made a fantastic exit for us. We were able to get much better valuations, spend a lot more comfortable time with the founders doing proper due diligence, and the founders were more focused on taking revenue from customers than taking funding from VCs, which is the perfect scenario for VCs who do not like to get diluted too much.
Absolutely.
All of those things combine, and that's the timing that we've been waiting for.
All right, Anirudh, thank you so much for taking time out and being here with us on Startup Street.
Thank you so much for having me.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.